The question on every Bay Area home buyer and seller's mind right now is, should I wait or should I act? And in this video, I'm going to break down the type of buyer that should be waiting, the type of buyer who should probably consider buying at this point, the type of seller who should be waiting, and the type of seller that should act in this moment. We're going to go into all of that coming up on this Silicon Valley Snapshot. Earlier today, I prepared a presentation for clients who are currently working with agents within our company here at the Selling Silicon Valley Group. But I thought, why be selfish and just give those to the clients that are currently working with us, but give back or give this information to all of you beautiful people out here in the YouTube universe and all of the other social media platforms that we syndicate this video to. So what I'm going to be doing is going over all of data, all the statistics that I've compiled to share with you the type of buyer and seller that should be waiting, type of buyer and seller who should be acting right now. But before we get into that data, and before we get into all of that, if you are a home buyer in today's marketplace and you're trying to figure out, should I be buying right now? Should I not be buying? And if I do, what is the data and what should I be offering and all that good stuff. So if you're a home buyer in today's marketplace and you'd like a comprehensive data set to assist you in your home buying decision-making, you can text the word data plus the area or the zip code or the neighborhood that you're looking in, and we will send that data set straight to your inbox. And if you're a home seller in today's marketplace and you're trying to figure out, how should I price my property to get the most amount of eyeballs on the home? We know that right now pricing strategy is more imperative now more than ever. So you can text the word data plus your property address to the number down below, and we will get all of that information sent straight to your inboxes. All right. So how is the economy affecting the Bay Area housing market right now? And the question is, should you wait or should you act? So there is some good news and there is some bad news. We're going to start with the bad news, as we always do. Right? So what is the bad news? Well, the bad news is that prices are going up. And here's a case study. So shout outs to my friend Shannon Ellison over at Intero. And she posted a video the other day, and I'm going to share that with you in just 1 second. And she had this listing in Santa Clara. It just went under contract last week, 271 Madrone Avenue, Santa Clara. The listing price, 1.898, 4 bedrooms, 2 baths. The square footage was 1687, lot size 7,829, and it was in original condition. So you can see here, this is the layout of the property. So obviously very much so in original condition. Now, this is Shannon's retelling of how that entire situation went down.
On the offer situation yesterday. So my listing on 271 Madrone Avenue in Santa Clara got crazy traffic. We had over 200 groups through the open house over the weekend, and then our offer deadline was yesterday. We received 26 offers. All of them were non-contingent. We were listed at 1.9, and we had 10 offers over 2.3 and 3 that were above 2.5. And we ended up ratifying for 38% above the asking price. And we did not list far under market value. We listed right around the market value for that home in this market. But man, did it go crazy. So moral of the story, the crazy buyers are back. Welcome to spring market in the Bay Area.
All right. So thanks again. And by the way, Shannon, you are a rock star. Great job with your clients there, or for your clients. You did an awesome job, obviously. And here's the bad news is that the multiple offer market is back. The crazy buyers are back. The spring market is in full force here in Silicon Valley, in the Bay Area. But there is a silver lining to this. There is some good news for us if you are a home buyer specifically. So for sellers, what you just heard right now is actually good news. So with bad news for buyers, good news for sellers. Now here is the bad news for sellers and good news for buyers, which is the good news that prices are down year over year. So we did an analysis, the square footage, the price per square foot for a similar home in Santa Clara in 2022 versus 2023. So in 2022, the average price per square foot, nearly $1,300 a foot versus 2023, we're at $1,041 per foot. So we are seeing almost a 25% decrease in prices year over year. So yes, home prices are going up right now, and we're seeing the buyers in full force driving prices up, but they're driving prices up from a discounted price. And so there's a lot of room, there's a lot of ceiling before we're breaking through that price ceiling that was created in the spring market of 2022, before before the rates went up. Now, this isn't just true in Santa Clara. Let's look at a couple of other markets here in the South Bay and in the East Bay. So in Willow Glen, average sales price of $2,213,000 in 2022. Now in March, 1.9. So the average price per square foot is actually down 21% year over year. In Evergreen, we're seeing a slightly different scenario, so slightly better scenario for, especially if you're a home seller, where the price per square foot is only down 13% year over year. Now, in Fremont, we're seeing the price per square foot down 17% year over year. So any way you slice it, the market right now is down. The good news is the market is down. But the bad news is, if you're a home buyer, the prices are quickly coming back up. Now, this is where we really start to see how it all comes together. I want us to look at what is happening right now in these specific counties. So if we look back a year ago in March and April of last year, this is Santa Clara County, we see pending activity exceeding for sale or inventory. This is the telltale sign of a white hot seller's market. So when you look at March of 2022, we're seeing pendings far superseding the amount of inventory that is on the market. Same thing in April, 1,320 homes pending versus 1,045 homes on the market. Now, after April of last year, we saw that trend flip and reverse. And in July, we saw that pending number kind of bottom out, or that delta kind of reaching a maxima. And then over the next couple of months, that delta started to shrink. And then finally in February, pendings broke through again. So now what we're seeing are 2 consecutive months in Santa Clara County where pendings are outpacing supply. If this trend, and when I say if, is it will continue. So as this trend continues, because there is no end in sight of the low inventory market that we're in right now, as this trend continues, we're going to see upward pressure on prices. As Shannon just said, 1.9 was not that far below the market value. So let's say the market value of the home was around $2 million, which according to my comparables is around what that home was worth. Well, 2.5 is literally 25% over 2 million. And so Santa Clara, if we go back here, was only down that mark was down 25%. So we are seeing pendings right now. We're seeing homes going pending close to the maxima of last year, despite the higher interest rates. And that's the punchline right now, is despite the higher interest rates, buyers have finally come to terms with the higher payments and they are willing to play ball. Cool. Let's flip over to Alameda County. Same story. March, April of this last year, we saw pendings far exceeding inventory levels. And in March, we finally saw pendings exceeding inventory levels, or exceeding for sale for the first time in nearly a year. That is very good news if you're a home seller. And I expect, just like in Santa Clara County, I expect in Alameda County for this trend to continue on for several months. Now, let's go to Contra Costa County. Same story. March and April of last year, and even in May of last year, we saw pendings exceeding supply. And now, finally, in March of this year, we are seeing that trend once again emerging in Contra Costa County. And I know what some of us are thinking right now at home is like, but Danny, what about the layoffs? Well, this is a really good question. And it's a question that really we can approach this in 2 ways. So I want to approach this from a demand and a supply standpoint, okay? Because clearly, just like anything else, housing prices will be dictated by supply and demand. Okay. So in terms of demand, well, as I mentioned a few weeks ago, we are seeing multiple offer market come back into the Bay Area housing market. And there have been instances of 20, 30, 40, 50 offers on properties. And even on properties where there are 10 offers, there is clearly way more demand than there are houses available right now. And so let's think about just what the potential impact of a massive layoff here in the Bay Area could do to demand. First of all, we have to think about how many of the current buyers right now have been impacted or are going to be impacted by the layoffs. And based on the research and all of the information that I've gathered myself, it looks like on the very high conservative is that 20% we see a 20% increase, see a 20% layoff, 20% that we see. Worst case scenario is that we see 20% of the workforce here in the Bay laid off. I don't see a scenario in which that happens, but let's say that it does. Let's say that we see 20% of the workforce laid off. Well, let's say that we see 20% of the tech workforce laid off. Well, good news is that tech isn't the only driving sector here in the Bay Area. There are other sectors as well. But let's just say that 20% of the demand, so 20% of the demand just dissipates overnight. Well, if all of a sudden we have only 8 offers on a property instead of 10, or we only see 16 offers on a property instead of 20, there's still 16 offers on the house. There's still 8 offers on the house. That decrease in demand will not impact the final sales price of a house. And so when we start to think about how oversaturated and how much demand there is in the marketplace right now, we start to really understand just how insignificant some of these layoffs could actually be to the overall vitality of the housing market here right now. And I know that's an inconvenient truth for a lot of us that are sitting back at home thinking, oh my gosh, it'd be awesome. It's like, the housing prices could come down even more. Well, here's the great news is that housing prices are down right now. The ones who are really smart were the ones that bought at the beginning of this year when they were at an all-time low. But now there is still an opportunity to get in before we see a massive run up on prices, because this Madrone Avenue, it is the preview of what is to come. Now, let's think about layoffs in another way right now. And let's think about layoffs in terms of demand. Now, if we see layoffs impact sellers, or we see layoffs impact a good portion of the homeowners right now, and they are forced to sell, coupled with a decrease in demand, that could be a recipe for a recalibration in the market or just a total decimation of the housing market. So there is still a possibility, and I do not want to rule out that possibility because it absolutely could happen. Do I think it's probable? No. Do I think it's possible? Unlikely, yes, but I do think it's possible. So let's wait and see how much these layoffs really impact the market. As we can see, though, in real time, so far, all of the layoffs that have happened, and there have been quite a few, they clearly have not impacted the housing market enough for it to come. It's white hot right now. It's hotter than it's been since this same time last year. So far, the market's proven to be extraordinarily resilient to the amount of layoffs that have occurred. So time will tell whether or not more layoffs will have a negative effect on the housing market right now. But in tandem with the housing or with the layoffs comes talk of the recession. And that's the next thing, is like layoffs are usually a precursor, or when I talk about layoffs or when layoffs are brought up as a concern, a point of concern with our clients here, the layoffs are really a precursor in someone's mind to an economic recession. And if you've watched this channel for a long time, or if you've watched my videos for a long time, you'll know that the recessions typically lead to housing appreciation. See, we have a recency bias here, especially in the Bay Area, where the last economic downturn, the last recession that we had in 2008, 2009 was caused by the housing crisis. And that housing crisis led to a massive drop in housing prices. And so this is what we need to remember, that the recession does not equal housing crisis. In 1980, we saw a 6.1 increase in home prices. 1981, a 3.5% increase. And in 2001, during the dot-com bust, a 6.6% increase in housing prices. The 3 out of the last 5 recessions and 7 out of the last 9, we have seen housing appreciate during recessionary periods. Now, the question is, how can this be? Danny, how is it possible that housing appreciates during recessions? Well, it's a great question. And this really comes down to what the government does and how the government reacts to recessions, because we have to understand, what is a recession? It's 2 consecutive quarters where the GDP is down. Okay. So with 2 consecutive quarters of a negative GDP, the government is forced to get creative and re-stimulate the market. And so typically where they start is interest rates. And to stimulate consumer spending, what they do is they lower rates. So this shows you the last 5 or the last 6 recessions, I should say, and what has happened to rates during those recessions. So we look back in 1980, we saw rates drop from 16% to 11.75%. In 1981-82, 18% to 13%. So a 5% decrease in interest rates. In 1991, we saw a decrease of 2.25% from 11% to 8.75%. In 2001, during the dot-com bust, we saw rates come down nominally, but they still came down. And that was enough to stimulate consumer spending. Now, obviously, in 0809, we saw a decrease in rates. And then in the mini recession here during the COVID period, we saw rates come down a whole percentage point from 3.75% to 2.75%. So the answer lies in the interest rates. And interest rates are the primary driver of demand, because when we think about layoffs, we're thinking about a portion of the market no longer being able to buy and a portion of the market being forced to sell. But what we don't consider is the reaction of the Fed and the rates inviting a new subset of buyers in the marketplace that were previously not candidates to buy a house. So when we decrease rates a percentage point, that is a decrease. That is a 10% decrease in monthly payments, which essentially means that we are re-inviting a large subset, or we are inviting, depending on how you want to look at it, we are inviting a new subset of home buyer into the marketplace. And that is the primary reason why we see housing go up during recessionary periods. Now, if you are a home buyer and you're like, you know what, Danny, that's great and all, but to be honest with you, we're just going to stick it out because we don't believe you. Okay, awesome. Don't believe me. Don't listen to me. In fact, I would encourage you to not listen to me. Listen to someone who is well-respected, has been featured in pretty much every major news outlet that you could possibly imagine. He is one of the foremost experts on housing and mortgage. Barry Habib. He's an economist that I've featured before on this channel. And this is what he had to say about the future of the housing market, not just here in the Bay Area, but nationally. Let's pay attention.
Now, demand. How do you calculate demand? Demand is calculated by household formations. So how do we see what a household formation is? Here's a simple example. Imagine mom and dad and a child. They live in one household. At some point in time, that child grows and moves out and gets their own place. It's still the same family. It's still mom, dad, and a child, but they now have two households instead of one. So they have formed a household. The next chart shows you in the blue lines for the last 20 years, how many households were formed in the United States. And the gold bars show you how many homes were completed by builders. Now, notice here in 2004 and 2005 was pretty close. There's another thing you should know. Because homes age and they have to be replaced over time, builders need to create about 100,000 more homes than there is demand, because those homes need to be replaced. So you could see in 2004, it was pretty well balanced. 2005, pretty well balanced. But holy cow, what the heck happened in 2006? Builders went crazy. They built more homes than they ever had in history, 2 million homes. Look at today. We don't even come close to that. We're below 1.5 million since then. We've never even come close. But 1 second here, the demand fell off a cliff. Why did household formations drop so much? And this imbalance created more supply than demand and too much inventory. The next year, it got even worse, because look how much more supply there was than demand. And by 2008, we had a full-blown housing bubble, ladies and gentlemen. And that was bad. It took a while for it to level off. But if you want to know why the housing market has been so strong, look at what happens here. Too much demand, not enough inventory, pushing prices higher. So now a lot of people, they say, oh, it's a housing bubble. It's going to be a housing bubble. Housing's going to crash. So many people putting that crap out there. Why? Go, because prices have gone up. Nope. Things don't crash because pricing has gone up. They crash because of imbalances in the system like this. So what we really need to ask is, can this happen again? Well, fortunately, we know how many homes builders are going to put up, because you can't snap your fingers and a home appears. It takes a while to construct that home. But not only that, you have to go through the process of plans, approvals, permits. So you have good visibility over the next couple of years as to how much inventory is coming on the market. And we know that's about 1.4 million homes. Now, remember, there's going to be about 100,000 homes that get retired each year. So it's really about 1.3 million homes that should be hitting the market for new supply. But could we see a situation where demand falls off a cliff like this? That's scary, right? Well, what caused this? Let's think about it. The median age of a first-time home buyer is 33 years old. So what happened? Why were there so many fewer 33-year-olds in 2006 and 2007? Why did the number drop so much? Well, maybe it might help us to take a look at, did something change in the birth rates? Fortunately, I have a chart that shows you the birth rates. So if you were 33 years old in 2006, let's do the math. That means you were born in 1973. If you were born in 1973, when 2006 came around, you were 33 years old. So let's look at the birth rates from 1973. And as you can see, here's 1973, and here's the birth rates. Holy cow. It dropped off a cliff and then fell again, leveled off before going up. That sure looks a lot like what happened 33 years later, didn't it? Drop, levels off, goes up. Well, that's because if these people were born, they're going to be 33 years old, 33 years later. So it should follow the same pattern. So why did this happen? Was there a reason, and can it happen again? Well, something did happen in 1973. Now, I'll give you the reason for it, but before we do, in today's day and age, a lot of people get awfully sensitive about things. So I want to just say as a disclaimer here, I have no opinion whatsoever. I am simply stating the statistical reason. So everybody, let's please just understand that. 1973, abortions were legalized. As a result of abortions were legalized, statistically, there were less births. And it followed suit into the next year. And then it leveled off and then started to go back up, which led to 33 years later, drop, level off and going up. So, okay, so we know that that's not.
It is startling just how corollary that previous chart was with this chart. And so this is not a coincidence. This is very much like, hey, the demand leveled off due to the decrease in birth rates. And then we're starting to see the birth rates climb. And notice what Barry is about to say, because this is important.
It's not going to happen again. So what does the future hold? We know 1.3 million homes are going to be the net that we're going to get. But how about household formations? Household formations in 2023, 33 years old. You were born what year, everybody? You were born in 1990. Let's take a look at birth rates from 1990. Whoa, big difference from 1973, isn't it? 74. You see, we're in a position where the demand is going to continue to outweigh the supply. Now, a lot of people are hibernating because we got awfully fast from 3% to 7%, and it caused some shocks in the mortgage market. As mortgage rates come down, and they will, recession, lower inflation, mortgage rates get more realistic, you're going to unleash a horde of buyers on the market. Now, let's really dispel.
Okay, so the question becomes, after seeing all of this information, after really digesting it, and by the way, hopefully that provides a new perspective, because it's not very frequent that we start to think about birth rates, the average age of the home buyer, and what that means for demand. That is a totally different way, I am assuming, than you have ever thought of demand versus supply. And so hopefully that exposes you to a new way of thinking about things, because we're so used to thinking about things and by the way, like, I am right there with you in that boat. I myself was very much unaware, oblivious to this line of thinking, but that's why Barry is who Barry is. And I have a ton of respect for the work that he's done. Obviously, he put a lot of thought and put a lot of time into that presentation. So the question becomes, if you're a seller, if you're a buyer, what should you do? So this is my opinion. I want to say that this is my opinion. Right now, if you are a buyer, you should wait. If you believe you are at risk of losing your job, obviously not everyone is safe right now. And so we have had clients, we're working with people who, for one reason or another, have reason to suspect that their job may no longer be there in 3 months and 6 months, what have you. And so if if you're in that boat, obviously you should probably wait, unless you have a spouse, a significant other whose income is enough to support the two of you, and they are not at risk of losing their job, and that would be enough to support the two of you plus the mortgage. If that's the case, then mazel tov, by all means, go for it. Now, for those who should buy sooner rather than later is pretty much everyone else. If this is not enough to put you over and really get you focused on getting into the market sooner rather than later, I don't know how else to help you, because right now the market is very much clearly still, you are buying homes at a discount from where they were a year ago. And everyone's waiting for the crash. Well, guess what? Like, you saw what housing did back in 2008. Housing was down 19.7%. Well, let's go back here. 19.7% in Evergreen, or in Fremont, 17%, in Evergreen, 13%, Willow Glen, 21%. We are seeing prices down right now, very close to how far they were down in 2008. If that doesn't scream opportunity to you, I don't know what else to say. And I don't know how else to help you. And I can tell you right now, it's like, I see the opportunity myself. And so if you're a home buyer and you don't see the opportunity right now, then I don't know how else to help you. Now, if you're a home seller, you should sell now if you're risk averse. So if you are hesitant to wait any longer because there are certain risk factors out there, like the ones that we've discussed today, that could lead to housing taking more of a beating, and you need to sell, meaning you're in a position where you should, you want to sell in the next 2 years. You want to get out of California. You want to get out of the Bay Area in the next 2 years, and you are more risk averse than risk tolerant. Now might be a good time to sell. Hey, as Shannon just showed you right now, there's a possibility to get very close to what your home was worth a year ago. I'd say that's a huge win. If you're a move up buyer, now is absolutely the time to sell and buy. The reason being, in an appreciating market like this, when most move up buyers, meaning you are selling a condo or a townhome or a smaller house and you're moving up into like that dream home, you've got a few kids, the condo's getting a little tight, the townhome's getting a little tight, or the 2-bedroom single family that you've got is a little tight. When we think about move up buyers, typically they are selling a less desirable asset for a more desirable or coveted asset, meaning a condo or a townhome tends to appreciate, or even a smaller single family, usually in a B or a C area, they're moving up into an A or B area. You're moving from an asset that is less desirable into one that is more desirable. And so what happens? The less desirable asset tends to appreciate at a lower rate in this kind of market than the more expensive, or than the one that is more coveted. And so what happens in this kind of market is that you start to see that delta increase as time goes on. And so if you wait 6 months and you're a move up buyer, your condo or townhome might appreciate, like, let's just say it's $1 million condo or a $1 million townhome, and you're going to buy a $2 million single family. It's quite the jump, but it's possible. Many of our clients do more than that. The $1 million condo appreciates, let's say 10% in the next year, but the $2 million single family appreciates 15%. It's in a better neighborhood, better schools, all of that good stuff. Okay, great. Well, the $1 million home, you made $100,000 more equity, but that $2 million house is now $300,000 more expensive. So that delta increased. The net was you're paying $200,000 more than you would have paid right now. So if you're a move up buyer, the longer you wait, the more of a disadvantage you're putting yourself at, and the less equity you're going to put yourself in a position to build over time. You're much better off being in that more desirable asset. Just bite the bullet and get into that next house sooner rather than later. If you're a seller, if you're not in those two categories and you don't really need to sell right away, then the answer is probably wait. Barry gave us plenty of good information here that would lead one to believe that over the next couple of years, prices are probably going to go up pretty significantly. And so if you are a homeowner and you have an asset that you don't necessarily need to liquidate, that you don't need to sell right away, the answer is probably wait. And that would hold true for the vast majority of home sellers in the area. Now, if you got to get, like, if the grandkids are in Arizona and you want to move out there, move, sell the house and get over there. But if there is not an extraneous force that is calling you somewhere else or calling you to sell or making you sell, then chances are you're going to have a lot more equity if you wait over the next 12, 24, 36 months. And buyers, if you're watching this right now, most sellers already know this, which is why you don't see a lot of homes on the market right now. And that is ultimately what is driving the prices back to where they were before, is this massive inventory shortage. Is sellers are sticking to their guns because they know what they've got. And unfortunately, or fortunately, depending on how you look at it, for buyers, that's the brutal way of the Bay Area housing market. And that's just going to continue to be the way for the foreseeable future. That's all I've got for you. So if you are still watching this video, first of all, what are you waiting for? Subscribe, click the notification bell, and give us a thumbs up. It costs you nothing. It helps us get in front of more awesome Silicon Valley and Bay Area home buyers and sellers just like you. That's all I've got for you today. This is Dana Gould, everyone. I'm selling Silicon Valley, and I will catch all of you in the next Silicon Valley Snapshot.